Welcome everyone in Finance for Engineers course, where you are about to learn one of the most important skills that will help you to manage your most important business resource successfully, that is money. Finance for Engineers deals with financial decision making in a business firm. See, in today's workplace, it is nearly impossible for an engineer to perform without considering the financial impact of every action on the organization's bottom line. Engineers need to be aware of issues such as cost reduction and capital investment and how their decisions can affect the financial statements. This information will help you understand from where the money is coming and where it is going, which will help you to make more efficient decisions. It will also reduce your dependency on others to make sense of the crucial financial information that you always need to keep a track of it. Finally, you will become more confident while dealing with your finance personnel and reduce the chances of any wastage of money, lacuna in processes, etc. This course introduces basic financial management to engineers and technical personnel who need this knowledge to manage a profit center effectively. So let us start with the first unit, that is financial statement and finance terminologies. Students, in this unit, we will try to find the answers to the questions like why company prepare financial statement, what is the use of financial statement, who are the people interested to know about the financial information of the company. Also, along with this, we will discuss the accounting principles underlying preparation of financial statements and the various important finance terminologies which are significant and one should know the meaning of the same. Anyone who starts to read financial news or reading financial statement will need a quick primer on the terms that are commonly used to help you get a better understanding of what you read. We will briefly explore terms commonly encountered in the financial management. So now, without wasting time, we will try to understand what is financial statement. See, a financial statement is an organized collection of data according to logical and consistent accounting procedures. Its purpose is to convey an understanding of some financial aspects of business firms. It is nothing but a formal record of financial activities and position of a business, person, or any other type of entity. The three most commonly prepared financial statements for small businesses are an income statement, a balance sheet, and a cash flow statement. These three statements help the users of the information in determining the financial position, liquidity, and performance of the organization. So let us try to understand the various uses of this financial statement. Why the organization should prepare these statements to determine the financial position of the business. The most important use of the financial statement is to provide information about the financial position of the business on a given date. This piece of information is used by various stakeholders like shareholders, creditors, banks, Various financial institutions, even government also require this type of information in order to take important decisions regarding the businesses. To obtain credit. See, this financial statement present the picture of businesses to the potential lenders, and this information can be used by them to provide additional credit for business expansion or restrict the credit so as to start recovery. As everything is mentioned in your financial statement, that what is the profitability of the business, what are the strengths and weaknesses of the business can be seen from the financial statement. One can take such type of decisions. Next is help investor in decision making. See, with the use of financial statement, of investor can decide whether to invest money into a particular company or not, whether to purchase shares of a particular company or not, as it contains all the essential information which is required by the potential investors for determining how much they want to invest in the business. It is also helpful in decision making regarding the price per share that the investors want to invest. A sound financial statement is the key to obtaining investments. Next is it helps in policy making to the government. The financial statement help the government in deciding the taxation and regulation policies based on which the company is running its operations. The government bodies can decide the tax brackets for the businesses based on the level of their income and asset. And the next is useful for the stock traders. These financial statements help the stock traders with the knowledge of situation the company is in, and therefore adjusting their quotes accordingly. See, these quotes are concerned with share prices. By looking at the financial statement, if the company is in a profit, they can quote high prices to the shares. If the company is suffering from losses or some problems are going on in a company, they can quote less price over there in a market. So again, this is very useful to the stock traders. So these are the benefits, significance of the financial statement. Now the next is users of financial information. Who are the people, who are the stakeholders using the financial information for decision making? See here, there are two types of users, internal users and external users. You can see here in internal users, the owners or shareholders, the directors, managers, and employees are the people. In external user, the suppliers, banks and financial institutions, the prospective investors, the government and regulatory authorities, researcher are the people interested to know about the financial information of the business organization. Now let us discuss one by one. The owner shareholder. Owner or shareholder are investing their money and definitely they expect return from the business. And for getting return, definitely it is expected that the business should be in a profit. The financial position of the firm should be good. Then only they can earn good return on the investment. So therefore they are interested to know about the financial information of the organization. Next is the directors, managers. These are the decision makers in the organization. They are deciding policies, they are taking decisions which impact on the various important activities of the business. So looking at the financial position, looking at the financial performance, they come to know that whether they have taken good decisions or they went wrong as the business has suffered a loss during a particular year. So, if the company has earned good profit, they can continue their decisions as the company is in a profit. If any financial distress comes due to their decision, they will avoid such type of decisions. So, therefore, it is essential for them to understand, to know about the financial information of the organization. Next, internal user is employees. Why the employees are interested to know about the financial information of the company. See, as they are working hard for the organization, they expect again good return in the form of salary. But if the company is in a profit, then only they can ask for the increment in a salary or wages, or they can ask for or they can demand the bonus. But for that purpose, it is essential to know about the financial performance of the company, whether the company is in a profit or not. If the company is earning good amount of profit, then here these are the people who can demand for increment. So these are the internal users of financial information. Next is external users. The suppliers. Who are the suppliers? Suppliers are the people who are supplying raw material to the organization. Even this can be the supplier of funds. So these are the people who are providing raw material on a credit basis or providing money to the business houses. So they are interested to know about the financial performance of the organization. If the company is in a profit, then they feel that yes, our money we can get it back with interest. If they have provided raw material on a credit basis, they can understand that yes, the company's position is good, company is earning good profit from years together, so they will return our money. There will not be any default from the side of the company. So they can rely on the financial performance, financial information, and can continue the relation with the company. Next is bank and financial institutions. As banks or financial institutions are providing term loans to the company, it can be a long-term loan, medium-term loan, or short-term loan. They are providing to the to the business organization for making an adjustment concerned with financial aspects. So here the banks are again interested to know about the financial position, financial performance of the organization, so that they will understand that yes, the company is having good financial position, the company is credit worthiness, and by looking at this information, they can continue the relation, they can provide more credit to the company even if required. So for that purpose, bank and financial institutions are interested to know about the accounting or financial information of the organization. The prospective investors, in earlier slide we have seen that by looking at the financial performance, prospective investors. Who are the prospective investors? See, prospective investors are the people who have excess money with themselves, who have excess saving with themselves and want to invest money into share market, want to purchase shares of any company. And before investing money in any company, normally they are interested to know about the financial performance of the company. So in that case, they collect the information about the good companies who are performing well. They read the statement, They analyze the statement and looking at the performance of the company, they purchase the shares of the companies. So they are the prospective investors. So these prospective investors again interested to analyze the financial performance, and if the position is good, performance is satisfactory, then only they invest their money into the company's shares. Now the next is government and regulatory authority. Government is interested to know about the financial information because looking at the information, they can levy the tax. Regulatory authorities, that is SEBI, is interested to know about the financial performance or the issue of shares, what is the financial position of the company, whether they have disclosed all the necessary information uh, to the investors or not. So this is somehow concerned with external users. And finally, the researcher. Researchers are the people who collect the information from various companies concerned with financial aspect, and they undertake the study, and they comment on the performance of the various types of companies, and such data can be used by the government for decision making. So various people are there who are interested to collect data concerned with financial performance and take important decisions. So thus internal and external users are there who are using this financial information. So now I think you must have understood what is why normally it is expected that the organization should prepare a financial statement. See, financial statement is nothing but it is giving an idea about the activities that are happening into the business, how the money is coming into the business and how money is used in a business, employed in the business, and what is the output, how much returns they are getting from that particular business. That is nothing but a profit or loss, the end result of the business activities done during a particular accounting year or a financial year. And that can be seen by using financial statement. So financial statement is nothing but a mirror. We can say the mirror through which when we look into that, we come to know that yes, this is the position of the organization. It highlights the strength and weaknesses of the organization. So this is about the financial statement. The various users are there, and for these people it is necessary to prepare a financial statement. Now see here three important financial statements prepared by the companies. First is income statement, next is balance sheet, and the third one is a cash flow statement. So let us see one by one the statement. So what is income statement? See, by the name only one can come to know that this statement is concerned with income. That is, it will definitely give you an idea concerned with the income of the particular business organization. How the business has earned income, what different expenses they have incurred over there, how they have uh, earned money, from which sources they have earned money. That can be seen from this income statement. See, the income statement shows the performance of the business throughout each period, displaying sales revenue at the very top. The statement then deducts the cost of goods sold to find gross profit. From there, the gross profit is affected by other operating expenses and income depending on the nature of the business. to reach net income at the bottom line for the business. That means what? It starts from sales and end at profit. So sales minus expenses is equal to profit is a formula normally used while preparing this income statement. Thus, it can be said that it is a report that shows how much revenue a company earned over a specific time period. A specific time period is normally a year. If in between also you want to see the earning of your business, you can prepare for 6 months. It can be concerned with a quarter, half yearly or yearly. If the owner is interested to know about, it also shows the cost and expenses associated with earning that revenue. So that means if so much money, if so much earning the company has done, income the company has earned, what different expenses occurred during a particular year can be seen through this statement. What are the key features of this income statement? See, it shows the revenues and expenses of a business. Normally, it is expressed over a period of time, that is 1 year, 1 quarter, etc. Usually, accounting principles such as matching and accruals to represent figures not presented on a cash basis and used to assess profitability. So income statement help us to assess the profitability of the business. What is this profitability? Income. What is the result, end result of the business? Whether the firm has earned profit or suffered a loss can be assessed through this particular statement. So if any person want to know whether the firm is in a profit or loss, it can be seen through income statement. So see here, it is a format of normally income statement. So in the books of company's name will come over here. We have to mention the name of a company in whose book you are writing these transactions, these accounts. On the top, it is mentioned the trading profit and loss account for the year ending on. That means this statement is for a year, and for which year you have prepared this, we have to mention that ending on 31st March 2010, 2020, 2022, whatever it is, you have to mention the period. Now you can see here particulars, amount, to amount column, again particulars and to amount column. So first amount column is the inner column and second amount column is the outer column. So in front of you, on the left hand side, whatever contents are there, or that side is called as a debit side, and on the right hand side it is a credit side. This is presented in the form of T. This particular format is called as T format, where debit side and credit side is there. So you can see here all the expenses written on a debit side, that is on a left hand side, and all the income is mentioned on a credit side. So on a debit side, you can see all the expenses, that is opening stock of material, then whatever purchases is made for the business. If returns are there, we have to deduct that returns. These returns are purchase return, which are also called as returns outward. Then wages paid to the workers, freight, carriage, clearing charges, packing charges, power and fuel, factory lighting and heating. All these are the expenses which are happening at a manufacturing level are mentioned on a debit side. Then on a credit side, you can see here sales, that is, we are earning money through sales. So it is on a credit side. If any returns are there, sales returns are there, we have to deduct it from sales. Then closing stock of material, if any. And then you can see gross loss. If the income is less than the expenses, definitely you must be knowing that the business will be in a loss. Income is less than the expenses, loss. And if the income is more than the expenses, the business will be in a profit. So both the side you can see, if loss is there, we have to mention it on a credit side, loss, and if the profit is there, we will mention it on a debit side as a profit. But this is a gross profit because it is at the level of manufacturing. Okay, so in this way we are mentioning, preparing a trading account. You can see certain amount I have mentioned in a inner column, and the total we have to take on a outer column. And at the end, we have to take the total must be equal at outer column. The difference will be gross profit or gross loss. That means from sales we deduct expenses and see whether the company has earned gross profit or loss. If debit side is more than the credit side, that means the loss has incurred. If credit side is more than the debit side, that means profit has earned. So this is a T format of trading account. Then next comes the profit and loss account. In continuation to this, next is profit and loss account. So you can see here exactly on the opposite side we have carried gross loss and gross profit. And then come all the other expenses which are not at all concerned with manufacturing. But these all expenses are concerned with administration department or selling and distribution department or finance department, that is payment of interest and all. So on a debit side again you can see all the expenses mentioned, that is salary, rent and taxes, printing stationery, postage, insurance, repairs, office expenses, interest, bank charges, sundry expenses, commission, discount, advertisement, carriage outward, traveling expenses, distribution expenses, bad debt. So all these are the expenses concerned with admin department, selling department, or finance department. Then on a credit side, you can see here commission earned. That means all the items which are concerned with earning money, income. So commission earned, rent received, interest received, discount received. So from which sources we have received money, we have mentioned on a credit side, and on the other hand we have mentioned all the sources where we have spent money. Okay, so here again you can see if the credit side is more than the debit side, that means your income is more than the expenses, you will be in a profit, which is called as net profit. And if your expenses are more than the income, then the difference is called as net loss. And by this we close the income statement. This income statement is in a T format. Most of the companies prepare T format. Most of the companies also prepare or present their data in vertical format. So one should know about the two different types of presentation of financial statement. So this is a horizontal format or T format in which income statement is prepared or presented. So let us now see the vertical income statement. Now in this format you can see only three columns, particulars and two amount column. Definitely first amount column is inner column and the other amount column is called as outer amount column, final amount column. So here you can observe all the items mentioned. Here differentiation is done. It started with gross sales. If the company has done any return or have company has return inward, then they have to reduce it, deduct it from the gross sales, and it is called as a net sales. So this vertical income statement starts with sales. Then from sales we deduct cost of goods sold. That means all the expenses related with manufacturing we mention under the head cost of goods sold. And when we deduct all the expenses from net sales, we receive gross profit. We arrive at gross profit. Then when we deduct all the operating expenses, what are the operating expenses? Operating expenses comprised of office and administrative expenses, that means which we have seen in an earlier slide, that is salary or audit fee, traveling expenses. So these are the expenses like printing and stationery are the office expenses. Then selling and distribution, these are the expenses related with the selling of product, distributing product. So it can be concerned with the commission paid or salesman salary or carriage outward. So all these expenses or advertisement expenses, all these expenses will come under the head selling and distribution expenses. Next is finance expenses. Finance expenses is nothing but the interest amount paid to the bank or interest paid to the debentures and all that we have to consider as a finance expenses. So addition of this is called as operating expenses, and we will deduct all these operating expenses from gross profit and we arrive at operating net profit. So operating net profit is not a final profit because yet we have to add, if any non-operating income is there we have to add, if any non-operating expense is there we have to deduct. What is this non-operating income or non-operating expense? The income or expense earned or expenses done on the activities which are not regular, we are not doing on a regular basis. That means by selling scrap, if we are earning good amount profit, then that means what, if we are thinking that by selling this particular scrap we can earn rupees 4,000, but we are actually earning 6,000, so 2,000 will be our profit because we are expecting only 4,000 from that sale of scrap, but instead of that we have earned amount rupees 6,000. That means 2,000 additional amount we have earned by selling that scrap. So that will be a non-operating income because we are not engaged in selling scrap. It is not our regular activity. So it will come under the head non-operating income. What is non-operating expense? The same case. We are expecting 4,000 from sale of scrap, but unfortunately we able to earn only rupees 3,000. So now 1,000 we are losing here. So that is a loss on sale of scrap. So that 1000 loss we will mention as a non-operating expense. Why? Because we are expecting 4000 and we are getting only 3000. So that 3000 is our earning, and what is the difference? 1000. That 1000 difference is nothing but written as a or loss on sale of scrap. So if it is income, we will add. If it is an expense, we have to deduct. And then we arrive at net profit before depreciation and tax. That means yet we have not deducted depreciation or tax. Then next title comes depreciation. We have to deduct some amount as a depreciation from the net profit, and then we arrive at net profit before tax, and on that we will calculate the percentage of tax bracket whatever is there. We will see in which tax bracket we are, so that much percentage we deduct, and then by deducting that tax provision, we arrive at net profit after tax. So this is the final figure in which we are interested, in which normally the investors are interested, people are interested. So it starts from sales and ends at profit. So how this journey happens? Sales minus expenses is equal to profit. The thing is, all the expenses we have deducted, we have bifurcated in various heads. So the expenses may be concerned with manufacturing, some expenses are concerned with office and administration, some expenses are related with the selling and distribution, some are concerned with the finance, some are non-operating expenses, depreciation. That means all the expenses we have divided and various head and mentioned. Otherwise, the thing is only one, that is sales minus expenses is equal to profit. So this is about the vertical income statement presented for a particular year or particular period. If it is for quarter, we have to mention that for a quarter ended on. If it is for a year, we have to mention clearly which year is. Now the next is balance sheet, a very important statement prepared by the organization. The word balance sheet is defined as a statement which sets out the assets and liabilities of a business firm and which serves to ascertain the financial position of the same on any particular date. What it means? See, this is a statement which shows the asset side and liability side. What are the assets of the organization, what are the liabilities of the organization, and by this way one can understand the financial position of the organization. And this statement is concerned or is related with only a particular date. On the left hand side of this statement, the liabilities and capital are shown. On the right hand side, all the assets are shown. Now see what is asset and what is liability. Assets are economic resources that are owned by the business, and from that the company expects some benefits, future income, while the liabilities are the obligations of a business to pay cash or provide services to other entities in the future. Now, what are the key features of balance sheet? It shows the financial position of a business. expressed as snapshot or financial picture of the company at a specified point in time. That means it shows the financial position of the organization on a particular date. That means on this particular date, what is the financial position of the company. On a next date, it may change. On an earlier date, it may be something different. So as of December 31st, 2017, this is the financial position of the company. On 30th December, it might be something different. On 1st of January 2018, it may change. Okay, so it shows what is the financial position, what is the asset and liability position of a company on a specified particular date. It has three sections: asset, liability, and shareholders' equity. So normally it is presented in a form of equation as asset is equal to liabilities plus shareholders equity. So this is very important equation which help us to understand the financial position of any business organization. So again here shown a balance sheet in a T format. In a T format, on the top it is written that balance sheet as on particular date. It can be concerned with 31st March 2020, 2021. And then on a left hand side you can see the liability, again two columns of amount, inner column of amount and outer column of amount. Next is asset side, then again two column amount, inner and outer. So on the liability side you can see various heads mentioned. Capital, in a capital we are adding if profit is there, we are deducting if the company has suffered a loss, then we are deducting drawings, that is the money used by the owner for his or her personal use. Then loan, if the company has taken bank loan or any personal loan, it gets mentioned on a liability side. Next, any mortgage is there, so it becomes a liability. Then after that, you can see current liabilities, a separate head under a liability. Under current liability, you can see sundry creditors, outstanding expenses, bills payable, bank overdraft. That means all these are the things whatever mentioned. We are liable to these people. That means we are liable to the sundry creditors. These are the people who have provided raw material on a credit basis and it is they are expecting from us money in return, but we have not yet paid. We are going to pay because see, in a business organization normally transaction happens on a cash basis as well as credit basis. Many times 70 to 80% transaction happens on a credit basis and only 20 to 30% transaction happen on a cash basis. So for that purpose, company create or design credit policies, design credit terms, and it can be said that after 30 days, 60 days or 90 days, we will pay money to the creditors. So creditors are supplying their material and now we have not paid them money, but after 30 days, we are going to pay them money. So it is a credit transaction. So these people are called as a creditors. That is the supplier of raw material become the creditor. If the transaction happens on a cash basis, then we will not treat them as a creditor because already we have paid them cash. So credit transactions related with the suppliers make them creditors. Okay, so these are the people whom we have not paid money, but we are going to pay it afterward. Okay, whatever terms and conditions are there, as per that we are going to pay money. So we are liable to these people. Outstanding expenses. These expenses are normally happened. We have spent money, but we have not paid money. That means we have done transaction again on a credit. That means uh, we we have taken a land on a rent, but we have not yet paid rent. We have to pay. We will pay after 1 month, so it becomes outstanding, not yet paid, but we have to pay. So same is the case concerned with bills payable and bank overdraft. That means all these items mentioned on a liability side shows the obligation of the company towards these particular heads. On an asset side, you can see non-current asset, which is also called as a fixed asset, which the firm owns. That is furniture and fitting, investment, plant and machinery, loose tools, land and building, business premises, patent and trademark, goodwill. So all these are non-current asset. The second head you can see on a asset side is current asset, which is cash in hand, cash at bank, bills receivable, sundry debtors, closing stock, prepaid expenses. That means what we own is mentioned here. So you can see fixed asset, all the items are for a longer period of time, while current assets have their life only of 1 year. So that is why they are called as a current asset. So this is a balance sheet T format. So let us see the vertical balance sheet. Here, in case of vertical balance sheet, we have to prepare two different statements. First statement is concerned with the sources of funds and another statement is concerned with the application of fund. Now sources of fund means from which sources the firm has raised fund can be seen. So see here share capital, under that equity share capital, add reserve and surplus, less expenses preliminary, which are preliminary while issuing shares and all. The total addition and subtraction shows us the equity shareholders fund. Then if the company has issued preference capital, that we have to add into equity and it gives us net worth, or the total of these two is called as proprietors fund. Next, which we have borrowed from outside. Under that, if the company has issued debentures, we have to mention it. Then secured loan, unsecured loan, these things we will mention. The total of that we have taken to the outer column and added to net worth. And by this we arrive at total capital employed. So by this way, you can see that the total capital employed amount shows us the how much amount is invested into a particular business and what are the different sources from which the firm has raised money for doing business activities. So these are the various sources, that is share capital or owner's fund and borrowed fund. Normally you can see here only two heads are there. Share capital is one head and another head is borrowed fund. So share capital head is nothing but owner's capital, and borrowed fund is called as debt fund. That is borrowed fund. Okay, so sources of fund, two sources are there, owner's fund and borrowed fund. This is one statement under balance sheet. Now the next is application of fund statement, which shows that all the asset or the application of funds where the firm has applied funds raised from various sources. So you can see here first heading is fixed asset. Oh, under that we will write all the fixed asset. Mention here only goodwill, land and building, machinery, etc. Then add investment. We have to mention investment separately. Then add working capital. Now here working capital is important. Under working capital, we have to write current asset, and from current asset we will deduct all the current liabilities, which will give us a figure of working capital. And by adding these three, that is fixed asset, investment and working capital, we arrive at total capital employed. That means the total amount applied by the organization, the total amount invested into the business activities. And the beauty of this particular statement is the total capital employed figure remains same. That means from various sources we have raised this much amount, and whole amount we have invested in various asset. So the amount remains same. That's why the title is also same, that is total capital employed. This is a vertical presentation of the data. So in this way, normally financial statement get prepared. So we are ending our session, today's session. Here we try to understand the financial statement, uses of financial statement, then what are the different uses of financial statement, then the T format of income statement and vertical format of income statement, then the horizontal format of balance sheet and vertical format of balance sheet. Now in next lecture we will continue with the next type of financial statement, that is cash flow statement. Till that, good day. Thank you.